right here on CNBC-TV18. Sailesh Raj Bhan is Chief Investment Officer, Equity Investments at Nippon India Mutual Fund, and he's a market master of the day. Sailesh, great to have you with us here. Thank you very much for your time. Appreciate it. Your thoughts, Sailesh, on earnings and markets put together with what the earnings trajectory is indicative of. So let's just begin with what you and your team made of the earnings season which has gone by. And have your team brought down overall earnings expectations for your portfolio companies? Go on.
Yeah, interestingly, like you said, earnings have been trending weak now for 2 quarters. This is the second quarter where we have seen earnings trend lower, and generally a little bit of worrying part here is the earnings are trending lower across. So it's a broad-based kind of a weakness in earning growth is what we have seen this quarter. See, we have been, even in our last conversations, we have talked about lower earning growth for the immediate 2-3 quarters, primarily because of what's happening globally, which impacts demand. And even locally, post October, the demand conditions are not very great, both rural and the urban side. And I think this is more, it requires some kind of a time correction in terms of, a couple of good quarters of economic activity and improvement, infrastructure spending, which will bring this back to normalcy. But in the near term, earnings are certainly trending weaker, maybe between 9 to 10% kind of earning growth broadly is possible, unlike our structural earning opportunity of 14-15%, which our companies can deliver, given our size of the economy today. So on the earnings side, there is at the moment very modest news. And I think it will still take a couple of quarters because the global situation has to improve. Domestic, as we enter into post the monsoon season, you may have meaningful recovery and domestic demand as well.
Sailesh, morning. Great to be chatting with you again. This is Surabhi here. So I have a question, a simple one. I mean, let's say for every incremental 100 rupees that you're getting, we have a very interestingly poised market as well. So will you be putting that incremental cash in consumption-oriented themes? Or would you be looking at manufacturing, capital goods, the old economy, capex intensive side of the market to park that cash?
Yeah, see, the way the markets have turned, Surabhi, in the last, or the way the valuations have turned in the last 12-18 months, you have seen a significant rally in manufacturing businesses and manufacturing and engineering businesses. So while their outlook for earning growth remains reasonably strong from a 3-5 year angle, today the valuations do factor in that, they cannot have any room for any disappointment in terms of growth there. While consumer businesses, which have been struggling and have been flattish or lower for the last 3 or 4 years, right? There the valuations are now trending to be reasonably okay. They are not cheap, but reasonably okay versus where the other components of the market is. And I think slowly the consumer space will also start giving you reasonable opportunities to participate because raw material prices are coming off. Demand, though is weak, should get better in a few quarters from here. And there the ownership has also been fairly low because we have seen significant 3-4 years of underperformance there. So I think you will have maybe consumption a little more preferred than investment in manufacturing today.
All right. Hi, Sailesh. Good morning. What about the IT space? Everyone was fearing a slowdown globally. Some of those numbers didn't look too bad. And actually, it's been a relative outperformer in the last 45 days or so. What's your sense on that space, on large cap IT or mid cap IT?
See, the IT space has, the fear of a very sharp decline in terms of demand. I think to that degree has not yet come about. But you must understand that these are a little early cycles in terms of, how the demand conditions will be behaving, especially when US has continued to remain fairly strong. As weakness in US because of higher interest rates feeds in, we just need to understand how companies and corporates behave at that point of time. So maybe you'll have clarity maybe in the next 3-4 months in terms of how demand conditions in the US are behaving. And hence, whether the earning growth outlook for these businesses is late single digit or, double digit will be visible maybe very clearly in the next 3-4-5 months because that will really decide on how the opportunity to execute comes about. The only point to note is that IT services companies have significantly corrected in the last 1.5 years in terms of where valuations stand. And they are also, in some context, relatively reasonably valued within the universe which was there. So it's unlike in the past where they were highly valued on high growth expectations. Now growth expectations have moderated, but valuations are also very, very normal now. So I think there is an opportunity emerging there clearly. We may have to meddle with lower growth for maybe a few quarters there, but I think given their cash generating ability and all that, the sector is getting attractive.
Okay. Sailesh, just one space, I don't know if you have a view, but it's been beaten out of shape, is consumer durables. It's not that large a space in terms of market cap, right? But any interest from the Whirlpool to Voltas to so many names, right? Havells, V-Guard, etc. There's a fair bit of price damage, yeah, it's a bit of a would be a contra theme if you were interested. But would you like to look at that space, or have you?
Yeah. So consumer durables are in some sense facing a perfect storm. After the rebound of COVID and all, and significant preponement in demand, you've got and now with higher inflation and prices hitting the income levels and hitting the kind of consumer sentiment, you have seen a slowdown there. Clearly, these are some of the most underpenetrated categories in India and have a very, very meaningful runway. And like you rightly said, these corrections have made valuations very, very normal now. They are no longer those 40 times, 45 times, 50 times earnings on very strong earning expectations. There would now be 25, 30 times on very modest earning expectations. So the risk reward is certainly becoming very interesting in this space. And I think we have seen reasonable consolidation, maybe a couple of more quarters of demand consolidation can happen in the sense demand remaining flattish and all. But I think this will get into a very good space with a 12-month kind of view. So we are positive in consumer durable space given the level of underpenetration, the correction in valuations, and obviously the cash generating ability of these businesses, which is phenomenal.
Okay. By the way, just want to point out on the market, Prashant, we are at that level of 18,120 that you were talking of. Steady, solid, there is no dithering at all. And it's a lot of, more of the same that's playing out. Tech Mahindra is one stock, and look at what's happening to Apollo Hospitals. Yeah. Again, it's in pole position, the Nifty winner, 3% up. I was going through a note that Jefferies came out with. Their price target on Apollo, they have a buy, and their price target is 5,375. They're really expecting more upsides. And I think the market's taken note of that statement that Ms. Reddy made on the channel yesterday, that losses in the digital business in 24/7, they have peaked out, and it'll get better from here on. So anyway, that's a strong, strong mover today. Sailesh, since we are on this subject, and of course in your earlier years, you've spent so much time picking stocks in healthcare and pharma. Let me ask you this, who better than you to tell us? I mean, these stocks kind of went off the radar, and for good reason, because the best of the COVID peak was perhaps behind them. How are you looking at healthcare and pharma?
The sector is very, very interestingly poised, both from a valuation and a recovery in earnings point of view, especially domestic demand-driven, domestic branded pharmaceutical businesses and the healthcare side, the diagnostics as well as the hospital space. So from a demand condition point of view, I think these are in reasonable, demand is getting normalized. It is becoming fairly reasonable and predictable now as we get along. And second, the valuations are like, it is among the cheapest sector effectively if you see broadly other than metals and some other areas. From a business which is such long-term sustainability, which it has, the valuations are very, very reasonable from where they stand. And I think these businesses also have meaningful earning growth potential from here because the base has been fairly battered because of higher raw metal costs. And then, you had demand, especially US demand conditions not being great, US pricing pressure was there. So I think earnings are fairly compressed. The opportunity to grow earnings early double digits is very real. The longevity of the businesses is very, very good. And hence the valuations which they are today, which are way below their normal, I think are present a very interesting opportunity.
Okay, all right, Sailesh, thanks so much for joining in this morning, giving us your take on a whole host of sectors that we just discussed. Wishing you a good day and look forward to chatting up with you rather soon.
Thank you so much. Yeah.
Well, for the time being, the Nifty is off the blocks in style. We were indicating an 80-90 point